Picture this. It is midnight.
Okay.
Outside your window, the city is totally quiet. The streetlights are buzzing. Traffic has died down to a trickle. And, most of the world is fast asleep.
Right. The physical world is asleep.
Exactly. But in the digital realm, beneath the surface of that quiet night, the financial markets are just, they're wide awake.
Oh, absolutely.
While you are sleeping, these algorithmic servers in data centers from London to Tokyo are quietly, methodically building the architectural foundation for the entire next day of trading.
It is a really compelling reality, and it completely flips the traditional narrative we have all been spoon-fed.
Yeah, like the Wall Street movie stuff.
Exactly. We are conditioned to think of the market as this loud, chaotic entity that suddenly just bursts to life at the ringing of a morning bell in New York.
With the guys in the trading pits yelling and throwing hand signals.
Yeah, the frightening floor traders on television, the flashing red and green lights, the sudden surges in volume. But the truth is, the market doesn't just randomly explode at 9:30 a.m. Eastern Time.
It really doesn't.
That morning chaos, it is simply the reaction.
Yeah.
The real structure, like the actual blueprint for where the money is going to flow, is built in the dark overnight.
And that brings us to exactly what we are doing today. We are jumping into a deep dive on the midnight open strategy.
It is a controversial one.
It really is. We are tearing apart a massive stack of source data to prove a premise that honestly, a lot of people push back on.
Which is that on your trading chart, time is actually more important than price.
Yeah. And to do this, we are pulling from everywhere. We have classic Forex forum archives from 2007 detailing Edward Reevy's foundational system.
The classics.
Right? And we have modern institutional concepts too, like the Inner Circle Traders New York Midnight Open. Plus, we are looking at these cutting-edge algorithmic indicator blueprints from platforms like TradingView.
It is a lot to cover.
So let's unpack this, because telling a trader to stop obsessing over price action sounds like telling a pilot to ignore the altimeter.
It sounds completely backwards.
We are always taught price is king, right?
Yeah, we are. But it is the paradigm shift that separates the retail trader from the institutional mindset. The retail trader is constantly reacting to those flashing lights.
Chasing the candles.
Exactly. While the institutional mindset proactively sets the board while everyone else is asleep. If you only look at price, you are basically just looking at the symptoms of the market.
Wow. Okay, that is a great way to frame it.
But if you look at time, specifically the midnight rollover, you are looking at the actual cause.
So let's start by defining our terms here, so you, listening right now, can actually picture this on your own screen.
Good idea.
When we say the midnight open, we are talking about the exact moment the daily trading candle rolls over.
Right.
Depending on how your charting software is configured, this is usually 008000 local time, or the midnight time set by your specific broker's server. It's the literal birth of a new daily candle.
And you really have to contrast the feeling, like the literal volume dynamics of that exact moment with the traditional market open.
They are night and day, literally.
Think about that New York open at 9:30 a.m. It is volatile. You have overnight news gaps being priced in, massive volume spikes as the American banking sector comes online.
And you have highly emotional retail traders throwing market orders at their screens because, they just watched a morning financial news segment.
Exactly. But the midnight rollover, it is quiet. It is structural. It is the period of the day when institutional positioning quietly takes place during the Asian and early European sessions.
One of our sources, a channel called The Rumors, dives deep into this specific dynamic.
Yeah, they have some great insights on this.
They really do. They point out that the market builds its structure overnight, and the morning open, that big, chaotic 9:30 a.m. push, is simply the expansion of what was already built.
The expansion phase, right?
Yeah. And they emphasize a golden rule that I want to drill into this discussion right now. Retail traders lose money in the morning because they're trading the middle of the range.
Which is just chop.
Exactly.
Yeah.
Just random noise in the middle.
That concept of the middle of the range is vital to understand mechanically. Let's step away from the tired cliche of the market being a battlefield for a second.
Okay, what is a better analogy?
Think of the overnight session, like building a dam in the dark.
Building a dam, I like that.
The institutions are quietly pouring concrete. They're establishing the absolute floor and the absolute ceiling of the water pressure. They are defining the opening range high and the opening range low.
So they're setting the boundaries.
Exactly. The space between those borders is just sloshing water. If you enter a trade in the middle of that range during the morning chaos, you have absolutely no structural edge.
You are just guessing which way the water is going to slosh.
You are gambling on the noise. Institutions, on the other hand, established their concrete walls hours ago. They set what is called the draw on liquidity.
Which is like a magnet, right?
Yeah, the magnetic price level they eventually want to drive the market toward to fill their huge orders.
And this ties perfectly into the ICT, the inner circle trader perspective mentioned throughout the sources.
It does. It aligns perfectly.
The market fundamentally moves in 3 distinct stages over a 24-hour cycle. You have accumulation, manipulation, and distribution.
The classic 3 phases.
Right. And that 0.00 candle, the midnight rollover, is the starting gun for the accumulation phase.
Yes. During the quiet hours after midnight, smart money is accumulating positions.
Because they have to, right?
They do. Because the overall market volume is relatively low during the Asian session, they can't just execute a massive block order all at once.
If they tried to buy everything at once, what would happen?
They would spike the price instantly and completely ruin their own entry price. They would be buying at terrible premiums.
So they have to be sneaky about it.
Very sneaky. They accumulate slowly, buying within a very tight, quiet range. They're establishing that foundation.
The concrete dam.
Right. And by understanding this 24-hour cycle, you completely shift your mindset. You stop being the reactive trader chasing big, flashy green candles at 10:00 a.m.
Which is what everyone does when they first start trading. Oh, everybody does it. But instead, you become the proactive trader who waits patiently at the borders established overnight.
But wait, I have to push back on this fundamental premise for a second.
Go for it.
If the volume is so incredibly low at midnight and during the early Asian session, isn't the price action just random noise?
How do you mean?
Well, I mean, if volume is thin, a stiff breeze, or just a single moderately sized hedge fund could move the market, right?
That is true. The order book is thin.
So why on earth should we trust a boundary, like a high or a low, that was formed during hours when most of the heavy hitters aren't even at their desks?
See, this raises an important question. And the answer is wonderfully counterintuitive.
Okay, I'm listening.
The low volume is exactly why those boundaries are so significant.
Wait, why?
Think about the mechanics of order flow. Because the range was built on low volume, establishing those specific highs and lows, it means that breaking out of those boundaries later in the day requires a massive injection of institutional capital.
Oh, wow. Okay, I see where you're going with this. A retail trader with a $10,000 account, or even a small prop firm, cannot break the overnight high. They just don't have the sheer monetary force.
You don't have the volume to crack the concrete.
Exactly. So when that boundary finally breaks, when the concrete wall of the dam cracks, it confirms true, committed market direction.
The boundary is basically the ultimate tripwire.
It is. It proves that real, heavy volume has finally entered the market to drive the trend.
That makes perfect sense when you break it down like that. The quiet builds the wall, and it takes real, undeniable money to break the wall.
It filters out the noise entirely.
So now that we understand why the midnight hour is mathematically and structurally crucial, let's look at how people have actually traded it.
Let's get into the mechanics.
Yeah. And to do that, we are going back to the absolute classic step-by-step method. We're opening up these forum archives from 2007, looking at the Edward Revy system.
That is a fascinating piece of trading history.
It really is. This was designed specifically for the daily chart, and it was heavily focused on the British pound to US dollar pair, the GBP-USD.
It is a beautifully elegant system in its simplicity.
There are no crazy algorithms yet.
Right. What is so freaking about Revy's approach is that it requires absolutely no complex indicators. There are no moving averages, no RSI, no AM and CD.
Just naked price action.
Pure price geometry in the specific time of midnight.
So picture your chart right now. It is exactly 00.00 platform time. A new daily candle has just opened.
Okay, I'm visualizing it.
The very first thing you do is look backward at the single previous day's completed daily candle.
Just that one candle.
Just the one. You identify its exact highest point and its exact lowest point, like the absolute tips of the wicks.
And here's where the strict mechanical rules come in.
Right, the 90 pip rule.
Exactly. Revy established the 90 pip rule. You measure the total distance from that previous day's high to its lows, including the shadows or wicks.
And if it's too small,
if that distance is less than 90 pips, you do not trade. Period. You close your laptop, you go to sleep, and you walk away for a full 24 hours.
We have to explain the scale of that for a second.
Okay.
Because 90 pips might mean different things on different assets. Why exactly 90 pips?
Well, what is the mechanism behind that specific number on the British pound?
Right.
In the context of the GBP USD, especially historically, the pound is notoriously volatile.
They call it the beast. Yeah.
They affectionately call it the beast, yeah, because of its massive daily ranges. A 90 pip move might sound like a massive swing to someone trading low volatility stocks.
Sure.
But for the GBP USD, if it hasn't even managed to move 90 pips in a full 24-hour period, the market is essentially dead.
So the big players are just sitting on their hands.
Exactly. It means the market is compressing, squeezing tightly into a range because buyers and sellers are deadlocked.
And if you try to trade that,
If you try to trade a breakout from a tiny 50 pip daily candle on the pound, you aren't trading a macroeconomic trend. You are trading random noise.
you are highly likely to get faked out.
Very highly likely. The 90 pip rule acts as a strict volatility filter.
There is another massive warning sign in this daily system too, right? The inside bar.
Yes, the inside bar is crucial to identify.
The rules state that if the previous day's candle is entirely engulfed by the candle from 2 days ago,
Meaning its high is strictly lower than the previous high, and its low is strictly higher than the previous low.
exactly. If you see that, you proceed with extreme caution, and many traders opt out entirely.
The inside bar is dangerous, and we need to understand the order book mechanics of why it's dangerous.
Let's break that down.
An inside bar represents extreme equilibrium. The market is winding up tightly, like a spring.
Okay.
But more importantly, think about where everyone is placing their protective orders. Every retail trader watching that compression is placing their buy stop orders just above that lower high.
To catch the upside breakout.
Right. And their sell stop orders just below that higher low. It becomes a massive concentrated cluster of resting liquidity on both sides.
So it is basically a minefield.
Exactly. So when the price finally breaks one way, say it breaks the top, it triggers all those buy stops. That creates a sudden vacuum, rocketing the price up.
That's a trap.
Often, yes.
Yeah.
The institutions, seeing that manipulated surge, step in, slam the price back down, and it shoots straight through the bottom, triggering all the sell stops.
Ouch.
That is the dual whipsaw. It takes out everyone's stop losses in both directions. It is the absolute worst-case scenario for a breakout system.
Which is exactly why Revi's system flags it immediately and says, stay away.
Precisely.
Okay, so let's walk through a perfect setup then. Let's say the previous day's candle is a healthy 120 pips wide.
Excellent. It passes the test.
It passes the test, and it is not an inside bar. We have a green light. How do you physically plan this trade at midnight?
Well, you are setting two pending orders.
You aren't just buying at market price.
No, absolutely not. At midnight, you set a buy stop order at the previous day's exact high, plus 5 extra pips,
Why the extra 5 pips?
to account for a little buffer against the spread and to avoid microscopic fakeouts.
Makes sense.
Then you set a sell stop order at the previous day's exact low, minus 5 pips.
So you are basically building a trap around the previous day's price action.
You are. Whichever way the market decides to break the next day, you automatically get pulled into the trade.
And risk management is hard-coded directly into the setup, which I love.
It has to be.
If your buy order triggers at the top, your stop loss is automatically placed at the previous day's low, minus 3 pips.
Right.
And if your sell order triggers at the bottom, your stop loss goes to the previous day's high, plus 3 pips. You are risking exactly the width of the previous day's candle.
Which is why you want a wide candle to begin with, to give the trade room to breathe.
Exactly. And for the exit, Revi originally targeted a flat plus 100 pips of profit.
A very mechanical target.
Or there are manual bailout conditions. You close the trade immediately if the new daily candle finishes forming and it looks like a doji.
Which is where the open and close prices are within 10 pips of each other.
Yeah.
Right. Signaling massive indecision.
Yeah. You also bail out if you see a shooting star pattern in an uptrend or a hammer pattern in a downtrend.
To truly grasp the psychological weight of this system, we can't just look at the rules in a vacuum. We really need to look at how it plays out over a grueling series of days.
And the forum source provides a fascinating 16-candle walkthrough that does exactly that. It perfectly illustrates the immense discipline required to trade this way.
Let's dive deep into that sequence because reading it is a masterclass in trading psychology.
Okay, imagine you are at your screen, day 1, candle 1 finishes. You measure it, it is over 90 pips.
Great. Green light.
Great. You type in your buy and sell orders, you set your stops, and you go to sleep. The next midnight, you log back in. Candle 2 has formed.
Okay.
But candle 2 is an inside bar. And the price never reached either of your pending orders. Nothing filled.
So according to the rules, you delete yesterday's orders, you measure candle 2, and you reset your new orders based on candle 2's new high and low.
But remember, as you're doing this, you know candle 2 is an inside bar. So you are consciously taking on a significantly higher risk of a whipsaw for the coming day. You are walking into a potential minefield, but you follow the rule.
Because the system dictates it.
Exactly. Day 3 opens. Sometime during the day, the price drops sharply and your sell order fills. You are officially in the trade, shorting the pound.
Awesome.
But then the price starts to drift back up. The day ends, and at midnight, you look at your account. You are currently holding a losing trade. You are in the red.
That is where the anxiety kicks in.
But your stop loss, which is way up at the high of candle 2, has not been hit. It is holding firm. What do most people do here?
They panic. They close the trade for a small loss because they just can't stand seeing red on their screen.
And that is the death of the retail trader.
It really is. The discipline to hold that trade is crucial. You didn't panic when candle 3 ended in the red because your structural stop lost the concrete wall of the dam held.
You trusted the architecture of the previous day's range.
Exactly.
And your patience is rewarded. Day 4 opens and the price absolutely rockets downward. It plummets into profit. You hit your mechanical target of plus 100 pips.
Beautiful.
You take your money, close the platform, and you won. But here is where the system really proves its worth.
This is the important part.
Let's fast forward to day 5. Candle 5 closes, and you measure it. It is tiny. It is under 90 pips, and it happens to be an inside bar.
So the market is dead and compressed.
The rules scream, do not trade. So, despite the high of winning 100 pips yesterday, you sit on your hands, you place 0 orders.
And the next day, candle 6 forms. And it is an absolute bloodbath on the charts.
Total chaos.
It is a massive, violent whipsaw that aggressively takes out both the high and the low of candle 5.
So if you had traded that day,
If you'd ignored the 90 pip rule, you would have had your buy order triggered and immediately stopped out for a maximum loss.
Yeah.
And your sell order triggered and immediately stopped out for a maximum loss.
2 full stop-outs in a single 24-hour period.
It destroys accounts.
But because you followed the math, because you respected the 90 pip filter, you were completely flat in the market. You watched the carnage from the sidelines, completely safe.
That is the true power of a mechanical rule-based system. It doesn't just find winners, it actively protects you from yourself during the untradeable days.
And what's remarkable about this era of trading is the time commitment. The author of this system noted that it literally takes roughly 5 minutes a day.
Just 5 minutes.
At exactly midnight, you log in, measure 1 candle, type in your pending orders and stop losses, and you walk away until the next midnight.
Here's where it gets really interesting, though, because the internet never leaves a good system alone.
Right, everyone has to tweak it.
As we read through these archives, the forums were full of traders debating and tweaking the parameters. You had a user named Matt suggesting we shift the entire 24-hour window.
Oh, instead of midnight to midnight.
Yeah. Instead of looking at a midnight to midnight candle, he advocated for looking at an 8 a.m. to 8 a.m. candle.
Why 8 a.m.?
His theory was that this captured a completely different, perhaps more relevant, cycle of London and New York liquidity.
That is a really valid point, actually.
And the debate over risk management was even more intense. You had a faction of traders arguing heavily that you should use trailing stops.
Which seems logical, right?
Their logic is totally understandable. If you were up 50 pips, you should trail your stop loss to lock in 20 pips of profit, just in case the market turns.
Makes sense.
But a very vocal user named Dogberry pushed back hard against this. He argued that hard stops are vastly superior.
What was Dogberry's argument?
He pointed out an inescapable truth of market mechanics. Markets breathe. They move forward, they retrace, and they move forward again.
Okay.
Dogberry argued that trailing your stop loss too tightly just gets you choked out of the trade by normal market retracements before the real macro trend even has a chance to begin.
It is the ultimate psychological dilemma in trading. Cutting profits early out of fear versus giving the trade enough room to breathe and potentially hitting its full mathematical target.
We will definitely get much deeper into that psychological friction later.
We have to. But here's the reality. While this daily chart strategy is brilliant for the patient, set-and-forget trader, modern markets move incredibly fast.
Much faster than 2007.
To see the true mechanics of how algorithms utilize the midnight open today, we can't just look at the daily candle. We have to zoom in.
Exactly. If we zoom out from the daily and step down into the microscopic level, we can examine the intraday architecture.
Okay, let's do it.
This brings us to the concepts popularized by ICT and what the rumors calls midnight madness. We're going all the way down to the 15-minute or even the 5-minute chart.
So when we look at the ICT New York Midnight Open, or NYMO, we are no longer looking at the entire previous day.
No, we are zooming way in.
We are focusing on a very specific, highly concentrated 30-minute window. Usually this is 12:00 a.m. to 12:30 a.m. Eastern Time.
That half-hour block is the crucible. It is where the algorithmic reference points for the entire upcoming session are forged.
Right. You take the exact opening price at that midnight moment, and you draw a perfectly horizontal line across your chart.
That line becomes your true north.
It introduces what the sources refer to as the dealing range perspective. You use that midnight opening price line to frame the entire market into two distinct zones.
A premium zone and a discount zone.
So if the current price is floating anywhere above that midnight open line, the market is in a premium. It's objectively expensive relative to the daily open.
Right.
If the price is below the midnight open line, it's in a discount. It's cheap. And the core philosophy here is that institutional algorithms love to buy in a discount and sell in a premium.
Which logically leads us to the midnight madness strategy. Instead of looking at daily highs and lows like Revy did, you go to the 1-hour chart and you meticulously mark the specific highs and lows created during the overnight session.
The Asian and early London sessions.
Yes, but you aren't just drawing lines. You are identifying liquidity zones.
We need to explain liquidity zones clearly because it is the engine of everything that follows.
It really is.
A liquidity zone is simply an area on the chart where thousands of retail traders have placed their stop losses.
Right.
Think about it. If a retail trader goes long, buying during the slow Asian session, where do they place their safety net? They tuck their stop loss right below the lowest point of that Asian session.
That is the logical place for a human trader.
Right. To a human trader, that's a safety net. But to an institutional algorithm, those clustered stop losses are fuel.
And that fuel is required for the manipulation phase. We talked earlier about accumulation, manipulation, and distribution.
Right, the 3 phases.
The accumulation happens overnight. Then comes the manipulation phase, which has a very specific, almost sinister name in ICP terminology, the Judas swing.
Okay, hold on. I need to challenge this.
Go ahead.
Because calling it a Judas swing and intentional betrayal sounds almost like a conspiracy theory. Are we really saying there's a centralized, malicious algorithm sitting in a bunker somewhere intentionally hunting the little guy? Or is this just the natural mechanics of order flow seeking liquidity?
That is the perfect question to ask. It is not a conspiracy of guys in a smoky room with a joystick.
Okay, good to know.
It is the cold, mathematical reality of order flow. Think of an institutional algorithm like a heat-seeking missile. But instead of heat, it desperately seeks resting orders.
Okay, follow the orders.
If a massive institution needs to buy 10,000 contracts of an asset, they can't just click buy at the current market price. There simply aren't enough sellers at that exact microsecond to fill the order.
Right, the order book would be empty at that specific price.
If they just bought aggressively, the price would skyrocket instantly, and they would get terrible fills on their order, completely ruining their profit margin.
So they need sellers.
They desperately need sellers.
Yeah.
So how do you artificially create a massive pool of sellers?
You trigger the stop losses.
Exactly. You drive the price down just enough to break below a key support level, like the midnight low. Retail traders see that breakdown, they panic, and their stop losses are triggered.
And what is a long trader's stop loss?
It is mechanically a sell market order.
Yeah.
Suddenly, a flood of sell orders hits the market.
Boom.
Liquidity.
The institution's algorithm now has the massive pool of sellers it mathematically requires to quietly absorb and build its 10,000 contract long position at a steep discount.
And once they have their position filled, they stop suppressing the price, and it violently reverses direction, rocketing upward for the rest of the day in the true direction of the trend.
Right.
The retail traders who saw the breakdown and sold short are trapped, and the traders who were long got stopped out right before the massive rally. That is the Judas swing.
It is not malice. It is a mechanical necessity for moving large volume.
Precisely. And there is a very specific visual footprint this leaves on your candlestick chart. The sources from the rumors call it the pitchfork, or more colorfully, the John Wick candle.
The John Wick candle is a brilliant visual.
It really paints a picture. Imagine a single candlestick with a long, aggressive wick that stabs down into that midnight liquidity zone, assassinating all the stop losses.
Love the dramatic phrasing. But then the actual body of the candle, the open and the close, rapidly pulls back up and closes safely inside the established overnight range.
That long, sharp wick is the undeniable visual evidence of the Judas swing.
It tells you the trap has been sprung, the liquidity has been absorbed, and the real move is about to begin in the opposite direction.
But here is the friction point. The hardest part of trading is identifying this in real time.
Oh, for sure. Hindsight is 20/20.
If the market naturally creates these Judas swings to absorb liquidity, how does a human trader staring at a live chart tell the difference between a fake out designed to trap them and a genuine committed breakout that they should actually trade?
Right. If a red candle breaks the midnight line, how do I know if I should follow it down or buy the reversal?
What's fascinating here is how the pure mechanics of price action answer that exact question. The sources detail two crucial mandatory stages for confirming a real move: invalidation and retest.
Let's define invalidation first.
A fake out, a Judas swing, is characterized by an immediate, almost desperate lack of follow-through. It breaks the midnight line, sweeps the liquidity pool, and returns to the safety of the range almost instantly.
So the breakout is invalidated immediately.
Exactly. It is a hit and run.
But a true, genuine breakout behaves entirely differently on the order book. A true breakout will displace strongly.
It will show conviction.
Yes, it will close outside the midnight range with heavy volume, creating large, full-bodied candles. But even then, you don't chase it. The most important mechanic is the retest.
A true breakout will eventually pull back and retest the broken midnight level.
The old ceiling becomes the new floor.
Exactly. If the price breaks out, comes back to the midnight line, and bounces off it as new support, that retest is your ultimate confirmation.
It proves that the breakout was real.
And more importantly, it proves that institutional money is actively defending that new level.
That distinction between a hit-and-run fake-out and a committed, defended retest is everything. But let's be totally honest with ourselves. Staring at 5-minute candles for hours, trying to spot a Judas swing or a perfect retest in real time is incredibly stressful.
It will make you crazy.
The human brain plays tricks on us. Adrenaline spikes. We see patterns that aren't there. To catch these fast-moving intraday traps and breakouts without losing their minds, modern traders don't just rely on manual drawing and staring until their eyes bleed anymore.
No, they use tech.
They use complex visual algorithms. Let's look at the tech that makes this possible.
The sources provided extensive, highly technical blueprints for several advanced trading view indicators. Specifically, they analyzed the Luxy ORB, the Tratisfy ORB Pro, and the ICT projections.
These aren't just moving averages.
Not at all. These are essentially automated heads-up displays for the midnight strategy architecture.
They completely automate the grunt work. Instead of you finding the exact 00000 candle, zooming in and out, and manually drawing horizontal lines that might be off by a few pixels, these indicators automatically parse the data feed.
And they draw the perfectly horizontal ORH, opening range high, and ORL, opening range low.
They even divide that total range into precise 25, 50, 75, and 100% mathematical quadrants.
And crucially, they plot the consequent encroachment. That is the exact 50% midpoint of the range.
Why is the midpoint so important to see visually?
Visualizing that midpoint is absolutely essential because, as we established earlier, trading near the midpoint is a statistical death trap. The indicator paints a literal line on your screen telling you exactly where the danger zone is.
What genuinely blew my mind reading the Luxy indicator specifications is the feature called multi-stage tracking.
It is a really powerful feature.
It doesn't just draw one opening range, it actively tracks and overlays the 5-minute, 15-minute, 30-minute, and 60-minute ranges, all simultaneously on the exact same chart.
Right.
But why layer them like that? Isn't that just visual clutter?
It sounds like clutter until you understand order flow cascades. Each time frame tells a different part of the narrative.
Okay, walk me through that.
The 5-minute opening range is your early warning system. It provides the fastest, most volatile signals. A break out of the 5-minute range might just be a quick algorithmic scalp.
A quick little trap.
Right. But the 60-minute opening range, that requires a full hour of accumulated volume to build. A breakout of the 60-minute range is a highly confirmed macro institutional signal.
Oh, I see.
By seeing them stacked on top of each other, you can actually watch momentum cascade from the micro level up to the macro level. You can see a 5-minute breakout gain enough volume to eventually shatter the 60-minute boundary.
That is incredible. But even with all those perfectly drawn lines, how do these indicators actively stop you from jumping headfirst into a Judas swing?
They use strict filters for confluence.
One of the most powerful filters detailed in the specs is the FVG filter, the fair value gap. We need to explain the mechanics of an FVG clearly. Let's use an analogy here.
Go ahead. I love a good analogy.
Imagine an institutional algorithm is a massive giant running through a muddy field. A fair value gap is the massive, undeniable footprint the giant leaves behind in the mud.
It's a solid visual. But let's break down the actual order book mechanism behind that footprint. Let's do it. Technically, a fair value gap occurs when a candle moves so violently and so rapidly in one direction that the wick of the previous candle and the wick of the subsequent candle do not overlap at all.
It creates a literal physical gap in the price delivery where trading was entirely one-sided.
Right. It means there was a complete vacuum of liquidity. Yeah. Imagine an auction where suddenly everyone stops taking bids except one guy who is just screaming higher and higher prices.
And there are absolutely no resting limit orders to absorb his buying pressure.
Exactly. So the price just skips levels entirely.
Right.
It leaves a gap in the chart because no transactions took place at those middle prices. It represents an inefficiency in the market created by sheer, overwhelming institutional force.
So how does the indicator leverage this mechanical truth?
Well, if a midnight breakout happens and the indicator's algorithm detects that the breakout pushed through a newly formed fair value gap, it signals a high probability green light.
It tells you, hey, this isn't just retail traders experiencing FOMO. There is a giant institutional liquidity vacuum backing this move.
It effectively filters out the low-volume fakeouts because a fakeout rarely has the sheer force required to leave an FVG behind.
Another fascinating piece of technology found in the ICT projections indicator is how it dynamically projects profit targets. It doesn't just guess where the market might go based on past resistance.
No, it uses standard deviation math.
Let's say the midnight range it calculated is exactly 20 points wide. The indicator takes that 20-point geometry and mathematically projects it outward. It plots horizontal target lines at exactly 1.0, 1.5, and 2.0 standard deviations away from the breakout point.
And it does this dynamically, which is crucial for psychology. The lines don't just clutter your chart all at once, overwhelming you with targets.
Right, it waits to prove itself.
If the price climbs and cleanly hits the 1.0 standard deviation target, the indicator then dynamically reveals the 1.5 target, effectively leading you up the ladder as the trend proves itself.
So what does this all mean for the person sitting in the chair? It translates all these abstract theories of liquidity and order flow into a practical reality that forcefully removes human emotion.
Which is the biggest hurdle.
When you are staring at a live chart, your heart rate is up, you see a big green candle, and every instinct in your body wants to click buy. But when the indicator flashes a bright orange label that literally says failed break right on your screen because its internal math calculated that the price couldn't hold outside the midnight line for more than 2 consecutive candles.
It saves you from a losing trade.
It acts as an objective, emotionless referee when your brain is compromised by adrenaline.
But here's the brutal reality of trading. You can have the Luxy indicator flashing a giant failed break sign on your screen. You can have standard deviations mapped out to the decimal, and you will still lose money if your finger is twitching on the mouse.
The tech can't fix you.
The most advanced algorithmic blueprint in the world cannot fix a fundamentally broken human mindset.
Which brings us to the psychology and risk management of actually executing this strategy. The sources dive deep into the math of survival. They detail built-in position sizing calculators within these indicators.
And this is vital. Professional trading isn't about guessing how many shares to buy based on how confident you feel. It's rigid, unyielding math.
Let's walk through the exact calculation. Let's say you were trading a $25,000 account.
Okay.
And your strict, unbreakable rule is to risk exactly 1% of your total capital per trade. That is a flat $250. Perfect. The indicators calculator looks at exactly where your midnight breakout entry price is, and it looks at exactly where your structural stop-loss line is placed.
Let's say you were trading a stock, and the distance between those two lines is exactly 50 cents. The calculator does the math instantly.
Your total allowed risk of $250 divided by the 50-cent trade risk.
It tells you exactly. Buy 500 shares, no more, no less.
Now let's say the next day, the market is wildly volatile. The distance to your structural stop-loss is now much wider, say a full $1.
You don't buy 500 shares again. The calculator divides 250 by $1 and tells you to buy exactly 250 shares.
Your financial risk remains an identical $250 every single time, regardless of how chaotic the chart looks.
That mathematical consistency is the only thing that keeps you in the game long enough to let your statistical edge play out.
But the placement of that stop loss is one of the most heavily debated topics in the sources. Where do you draw the absolute line in the sand where your thesis is proven wrong?
Well, you have the classic Edward Reesy method we discussed, placing the stop on the absolute opposite side of the daily candle.
But as user Dodgy pointed out in the 2007 forum archives, using a full daily candle stop can mean suffering a highly painful 150 to 200 pip drawdown before you finally get stopped out.
Right. The risk-to-reward ratio on a full daily candle stop can be brutal for a smaller account. So modern variations offer mathematically sound alternatives.
Like the 50% range retracement stop. Let's visualize this. If the midnight range is 40 points wide from top to bottom and you buy the breakout at the very top, your stop loss goes exactly at the 20-point midline.
The consequent encroachment we talked about earlier.
Exactly. The logic is sound. If price falls all the way back into the exact center of the overnight range, your breakout thesis is fundamentally invalidated anyway. The market has returned to equilibrium.
So why risk the full width of the range?
Exactly. And then you have the ATR stop, the average true range stop. This is brilliant because it actively adapts to the market's current macroeconomic heartbeat.
If the market is moving sluggishly, the ATR stop hugs the price tightly, reducing your risk.
And if the market is wildly volatile because of an impending news event,
the ATR stop widens out automatically so you don't get stopped out by a random, meaningless twitch in price before the real trend begins.
But all the math, all the ATR calculations in the world can't fix the trader's mind. We have to address the deepest psychological friction of the midnight strategy.
And the biggest demon in the room, without question, is FOMO, the fear of missing out.
FOMO is lethal because to trade this strategy, you have to actively fight your own nature.
Imagine this scenario. It is 9:30 a.m., the New York bell rings. Your Twitter feed is screaming about a massive rally. The financial news channels have flashing red and green graphics.
The candles on your chart are painting massive blocks of color surging upward.
The psychological urge to just jump in, to click buy at market price just to feel like you are participating is absolutely overwhelming.
But you have to remember the golden rule of the strategy. The middle of the range is where traders lose money.
The midnight strategy requires you to sit quietly in the middle of that 9:30 a.m. chaos, look at the opening range high and low, and do absolutely nothing until the price actually reaches the structural border.
To actively combat that human weakness, the indicator specs describe a feature called a pullback filter.
This is a lifesaver for impatient traders.
It really is. It is a toggle you can turn on that literally forces you to wait. Even if the price breaks out of the midnight range with massive volume, the indicator won't give you a buy signal.
It forces the system to wait for the price to pull back exactly 2% and then break out again before finally giving you the green light.
It effectively hard-codes patience into the software to overrule your adrenaline.
If we look deeply at the psychological aspects mentioned in the sources, particularly referencing Mark Douglas and his foundational work on the trading mindset, there is an intense discussion about the urge to cut profits early versus letting them run.
We talked earlier about user Dogberry arguing vehemently against trailing stops. Let's break down the psychology of why trailing stops fail so often.
Let's play out a scenario. Your midnight breakout triggers perfectly. You are up 30 pips, the screen is green.
You feel like a genius, but simultaneously you are terrified the market will turn around and take your 30 pips away.
Exactly. So to alleviate your own psychological anxiety, you move your stop loss up from its structural base to your exact entry price.
Your break-even point. You think, great, a completely risk-free trade. I can't lose money now.
And that exact desire for a risk-free state is exactly how you kill the trade. The sources, leaning heavily on Douglas's probability mindset, argue that moving a stop loss to break even too quickly strangles the trade before the daily trend can establish itself.
Because markets breathe.
Right. They move up 40 pips, they retrace 25 pips, they move up another 50 pips. If you move your stop to break even at plus 30 pips, the natural, healthy retracement of the market will clip your stop loss, take you out of the trade for zero profit, and then proceed to march 150 pips in your original direction.
You let your anxiety rob you of your statistical edge. You have to mathematically accept the risk and let the trade breathe.
But this sounds agonizing, I know.
It really does. It sounds like this strategy requires you to sit on your hands and do absolutely nothing 80% of the time. How do you fight the psychological urge to do something when you're just staring at a chart for hours, waiting for a midnight line to break, and then waiting hours more for the target to hit without touching your stop loss?
It requires a fundamental foundational shift in how you view your actual job as a trader. You're not paid to click buttons.
Okay.
You have to utilize tools like the one trade per day toggle found in the indicator settings to forcefully limit yourself. You have to accept the psychology that the setup either triggers cleanly over the midnight line or you walk away.
Your job isn't to trade. Your job is to wait for exact parameters to be met. If the trap isn't sprung, you don't fire.
That is the hardest lesson to learn.
Okay, so we've covered the history of Revy, the mechanics of ICT, the standard deviation tech, and the psychology of Mark Douglas. But let's ground this in reality. Does this rigid, rule-based setup actually apply across totally different asset classes?
That is a great question.
Does a manipulated commodity like gold behave anything like the British pound? Does a 247 digital asset like Bitcoin even care about a concept like midnight?
This is where the sheer versatility of the Midnight Open becomes truly apparent, because you aren't trading the asset, you are trading human liquidity. The indicator specs, like Tratisfy and Luxy, specifically highlight applying this logic dynamically across vastly different markets.
Let's start with Forex. We mentioned Edward Reevy's daily averages earlier. This is crucial for setting mechanical targets without guessing.
You don't guess where to take profit based on a feeling. You look at the historical average.
The GBP/USD moves an average of 180 to 200 pips a day. The USD is significantly slower, moving 110 to 120 pips a day.
So your mechanical take-profit target for a midnight breakout is strictly set at exactly half of that asset's average daily true range.
If you are trading the euro, you automatically target 55 pips. It entirely removes the guesswork from your exit strategy.
Now compare that relatively slow Forex environment to futures. Specifically the S&P 500 index and the NASDAQ. These markets trade nearly 24 hours a day, just pausing briefly for maintenance.
So how does midnight play into that?
Here, the midnight strategy is hyper-relevant. The overnight Asian and European sessions build incredibly tight consolidation ranges. They build the concrete dam. They build the massive liquidity traps above and below.
And when the U.S. wakes up?
When the explosive U.S. volume pours in at 9:30 a.m., it is not randomly creating new structure out of thin air. It is simply algorithmic volume, hunting the liquidity resting precisely above and below that overnight range.
It's the violent expansion of the overnight structure. But what about commodities? What about gold? The Tratisfy ORB Pro logic specifically notes that gold requires a highly unique session boundary, completely separate from the standard London or New York opens.
Gold is a fascinating beast. It is a heavily manipulated, highly volatile asset driven by global macroeconomics. Imagine a scenario on your chart where gold ranges very tightly during the entire Asian session.
It just chops sideways, moving maybe $1 or $2 for 8 hours.
What is happening under the surface? Retail traders are getting bored, taking small scalps, but they are leaving massive pools of stop-loss liquidity just above that overnight high and just below that overnight low. The coiled spring is winding tighter and tighter.
And then right before the New York Open.
Exactly. Right before New York opens, the algorithms aggressively sweep the high. They print a massive John Wick candle that spikes violently through the overnight high, triggering every single retail buy-stop order.
And then it violently rejects, closing all the way back inside the overnight range.
That aggressive sweep of the overnight high is the perfect institutional short setup. The algorithm grabbed all the buy-side liquidity it mathematically needed at a premium price, strictly to fuel a massive sustained sell-off for the entirety of the New York session. If you mapped the midnight open, you saw the trap perfectly.
And finally, let's talk about the absolute Wild West. Crypto. Bitcoin never sleeps. It's truly a 247, 365-day market. There is no opening bell. There is no closing bell.
No structure.
Right, so in a market that literally never closes, what exactly is midnight? How can you have an opening range without an open?
That is the core structural challenge of crypto. Since there is no official daily rollover executed by a central exchange, traders have to artificially force a daily reset to apply this logic.
How do they do that?
The TradingView indicator settings provide an elegant solution for this. Utilizing custom session hours, you configure the software to track from exactly 00.000 to 23.59 UTC, Coordinated Universal Time.
Okay, so UTC becomes the standard.
That arbitrary boundary becomes your synthetic day. It gives you the structural framework you need.
Okay, so you apply the UTC boundary to force a daily structure. But does Bitcoin, an asset driven by totally different market participants, actually respect these traditional liquidity concepts?
If we connect this to the bigger picture, the answer is a resounding, undeniable yes. Because regardless of whether you are trading a physical ounce of gold, a futures contract on the S&P 500, or a digital token on a blockchain, the underlying mechanics are identical.
Human nature doesn't change.
Exactly. You are fundamentally trading human fear, human greed, and the algorithmic programming designed to exploit both. In Bitcoin, a failed setup, a Judas swing, often looks incredibly dramatic.
You will see a massive wick that trips the breakout alarm, shoots thousands of dollars in one direction in a matter of minutes, but by the close of the 15-minute candle, it pulls all the way back inside the synthetic opening range boundary.
A colossal, multi-thousand-dollar Judas swing.
Yes, and when you see that on the Bitcoin chart, a clear, undeniable sweep of the UTC midnight boundary that completely fails to hold its ground, it is a glaring high-probability signal to immediately reverse your bias.
The market just tipped its hand. It showed you exactly where the fake out was, which means the real institutional volume is heading aggressively in the opposite direction.
It's genuinely incredible how universal these core concepts are when you strip away the asset class. From Edward Ravey manually measuring 90 pip daily candles on a clunky 2007 Forex forum, to ICT's psychological warfare of institutional Judas swings, to today's automated standard deviation projecting software suites mapping fair value gaps in milliseconds.
The tools have evolved exponentially, but the core truth of how liquidity moves remains exactly the same.
The market is fundamentally a machine designed to transfer wealth from the impatient to the patient. And the midnight open strategy, in all its various forms, is simply a mathematical framework for that patience.
It's a way of reading the architectural blueprints of the market's intentions long before the actual building is constructed for the public to see.
So we'll leave you with this final provocative thought to mull over as you look at your own charts. We spend years, decades even, studying price patterns. We look for head and shoulders, ascending triangles, falling wedges, double bottoms.
We obsess over price.
We really do. But what if the ultimate indicator isn't price at all? What if the most powerful predictive force on your chart is simply time?
If you can fully understand the 24-hour cycle.
Exactly. If you can map out exactly when the algorithms are accumulating in the dark and when they are distributing in the light, well, if you control the clock, do you control the chart?
It completely changes how you look at the screen. You stop seeing chaos and you start seeing the schedule.
Now, we want to hear directly from you. Have you actually tried trading the midnight open strategy? What specific market did you test it on? And what exact results did you get? Did you get caught in a Judas swing because you didn't wait for the retest, or did you catch the true expansion? Let us know. Keep digging, keep questioning the consensus, and keep learning.